There is a kind of airdrop farming, where the thing being measured is not what you held or how long you held it, but simply how much you traded, the number people call volume. I mean the Perp Dexes, where you trade leveraged longs and shorts on chain, and many of them hand out rewards to the wallets that traded early and often. These are the Perp Dex airdrops, and the pitch could not be simpler. Trade a lot and qualify for a lot. The catch is that volume is at once the most expensive signal you can chase and one of the easiest to fake, which makes it the most dangerous number to farm blindly in the whole space. I run real proxy and cloud phone farms for a living, and I treat airdrop farming as operations rather than a lottery, which means I watch the signals that are hard to fake and the costs that are easy to ignore. None of what follows is financial advice, none of it predicts a token or a price, and nothing here promises you a drop of any kind. It is simply how these venues measure people, why chasing raw volume is the fastest way to burn real money looking busy, and what holds up when a Perp Dex decides who its real traders were. So start with what a Perp Dex actually is, briefly and honestly. It is an exchange for perpetual futures that lives on chain, a place to take a leveraged long or short without holding the underlying asset, and without handing your coins to a company that keeps the book. You post collateral, open a position larger than it, and pay a small fee to trade. Projects like this launch, gather real traders, and later reward the wallets that genuinely showed up. It is the same retroactive pattern you see everywhere, measured here in the size and the fees of what you traded. And here is why volume became the number everyone chases. It is trivially easy to count, and on a real exchange, it correlates with a healthy, busy venue. So it is the obvious thing for a young Perp Dex to reward, but it is also the metric most divorced from any genuine conviction. A wallet that pushed $100 million of notional through the book has proven that a script can churn size on cheap fees and very little else. After the raw count of transactions, volume with nothing behind it is about the weakest signal there is, because it is the one people work hardest to inflate. So a serious perp distribution leans on what the volume actually cost you, because size alone is cheap to fake. The honest measurements lean on what volume cannot manufacture for free, the fees you genuinely paid, the spread you crossed, the liquidity you provided as a maker rather than only taking, the positions you held with risk across weeks rather than round-tripping in seconds. It is the same shape as every honest airdrop, breadth and depth and longevity together, with a sharp discount on volume that clearly went in a circle and cost nobody anything. There is a trap that is special to volume farming, and it is worth naming plainly: wash trading. Because a long and a short cancel out. An operator can open both against himself or trade between two of his own wallets, sending the same size back and forth to run the volume number up while the net stays flat. It is one of the easiest patterns in the space to recognize, because real trading has direction and an uneven, purposeful shape, while a wash loop nets to zero and goes nowhere. A distribution built to find real traders reads that difference and sets the looped volume aside. And there is a plain cost reality underneath all of it, because volume is never free. Every unit of size you push pays a taker fee, crosses the bid and the ask, and on leverage risks being liquidated if the price moves against you. So $100 million of wash volume is not a clever trick. It is real money burned in fees and spread to look busy. That pushes you back to the one rule I hold onto through all of this. Only put on trades you would genuinely want on anyway, at a size and a risk you would accept with no reward attached. The leverage deserves its own honest word, because it is the cost that hurts people most here, and not one you can wave away. Farming volume with borrowed size means a move against your position can wipe out the collateral behind it in a moment, with a stop the market controls rather than you. You are not parking capital to earn points. You are taking directional risk against a market that owes you nothing, and the bigger the size you chase for the volume number, the more real that risk becomes. I am flagging leverage as a danger to weigh, not handing you away to trade, and certainly not telling you which way any price will go. There is an identity reality here too, and like everywhere on chain, it lives in the funding. A wallet is just a key pair, free to generate by the thousand, which is why generating them is never the hard part, and never the signal. The moment you fund a swarm of them to spread your volume across many traders, you draw a funding graph, a plain picture of where the money came from. Fund 100 wallets from one exchange withdrawal, or push them all out of a single source wallet, and you have tied every one of them together at the root before a single trade is placed. Now the defensive part. Explain the way I always explain it, from the outside and honestly. A Perp Dex and the analyst who design its distribution, no one operator will be tempted to fake a whole crowd of traders, wallets funded from the same place, running the same size in the same window, often trading against one another to move volume between them. That coordinated block reads as precisely what it is, one entity wearing many hats, the same way a cluster of trading wallets gives itself away anywhere on chain. I am describing how that detection works so you understand the terrain, not handing you a method to slip through it. This is why farms of near-identical trading wallets get discounted, often wholesale. Real traders are messy. They take different sizes at odd hours. Some win and some lose. Some hold overnight and some scalp in a minute. Some hedge and some do not. 100 wallets that each receive the same round number from the same source ran the same round trip of the same notional in the same hour and often filled each other. Do not look like 100 careful traders. They look like one operator counted 100 times. The clustering reads the shared funding, the identical size, the synchronized timing, and the wallets crossing each other, and sets the whole block aside. It is worth stopping on what the points balance actually is, because perp dashboards are built to make it feel like money. Many of these venues run points across seasons long before any token exists, and the weighting is entirely theirs to design. A points balance is a private scoreboard the team is keeping. A tally, it may later convert into a token on whatever terms it decides. A huge number glowing next to your volume is a promise about a decision that has not been made, and treating it as money already earned is the cleanest way to burn a season of fees for very little. The timing lesson from the rest of airdrop farming carries straight over. Trading history accumulates, and you cannot backdate it. A wallet that starts churning volume the week a token is rumored has exactly that much behind it, however enormous the number looks, while a wallet genuinely trading the venue months earlier carries a weight the late one cannot manufacture. Being early here is not a burst of size you perform at the last minute. It is risk you actually carried before there was ever a drop to chase. The risks here are real and worth stating without spin. A Perp Dex can run for a year, take your fees and your liquidations and your attention, and never issue a token at all. It can issue one and draw its eligibility line somewhere that leaves you out. It can change its formula late, cap the volume it counts, or decide the looped size you ran no longer qualifies. And underneath all of that, the leverage can liquidate you regardless of any airdrop on a bad candle in a market that does not care what you are farming. This is real capital at real risk over real time against a decision you do not control. Read the actual rules of each program too, because they genuinely differ. Some weight the raw volume you traded, some the fees you paid, some the liquidity you provided, or the time your position stayed open, and some go out of their way to penalize the obvious self-crossing of a swarm of wallets. Those are different worlds, and assuming the wrong one can waste a whole season of fees. I will not tell you a given venue or token is safe, legit, or a scam as a blanket label, because that is not mine to declare in the abstract. Read what the team publishes about how it thinks of real traders and judge it on what it shows you. Treat the whole thing with plain ops discipline. Keep an honest record of every venue you traded, from which wallet, how much notional you pushed, what you paid in fees and spread, and whether you would still trade there with no drop at the end. Then read that record without sentiment and prune it. A venue you only churn size on to chase points, whose fees quietly ate more than you noticed, is a cost to stop paying. The operators who do well here are not the ones wash leaping notional across a swarm. They are the ones trading a couple of venues they genuinely understand. What actually protects you is trading you would do anyway. A wallet that genuinely traded a venue at a size and a risk you would accept with no reward attached, held its positions like a person rather than a script, and came back across months, is indistinguishable from a real trader for the simplest possible reason. It is one. There is no swarm to hide inside, no funding trail to explain, no self-crossing to account for. Because you are not performing volume across a crowd of clones, you are trading as yourself. If my only reason to add size is the drop, I weigh the fees and the liquidation risk I would take on to get there, and usually I leave the size where it was. So the reframe I would leave you with is this. Farming Perp Dex airdrops is not a scheme to wash the same notional across a swarm of wallets until the volume number looks enormous. It is a decision about how much real trading you would genuinely do at a venue, at a risk you would accept anyway, placed plainly as one person, which venues are actually worth the fees and the risk, how these programs weight real volume, and the trackers I use to log the notional, the fees, and the profit and loss on each wallet are all written up in full at airdropfarming.org, with no hype and nothing there being financial advice or a promise about any drop. Subscribe if you want the operator view of this trading volume treated as risk you actually weigh rather than a number you blindly inflate, and the honest caveats left in every single time. Next time we take one per venue from the first real trade through a full season of trading it the way I genuinely would, and watch how volume placed with real risk earns standing far more reliably than a swarm of wallets wash looping the same notional between themselves in suspicious unison.